Hi class, welcome to Module 11, Loan to Own. Understanding installment loans is important when borrowing money to make purchases. This module will help you understand what installment loans are all about. After completing this module, you'll be able to identify various types of installment loans, explain why installment loans cost less than rent-to-own services, identify the questions to ask when purchasing a car, and explain why it is important to be wary of rent-to-own, payday loans, and refund anticipation loan services, and identify how federal laws protect you when applying for a loan. What is an installment loan? An installment loan is a loan that is repaid in equal monthly payments or installments for a specific period of time, usually several years. What are examples of items that can be purchased with an installment loan? Cars, furniture, computers, household appliances. There are two types of installment loans, secured loans and unsecured loans. A secured installment loan is one in which you offer collateral for the loan. The interest rates for secured loans are comparatively lower than unsecured loans. You must give up the collateral to the lender if the loan is not paid back as agreed. Mortgages and home equity loans are examples. What does collateral mean? Collateral is security you provide the lender. Giving the lender collateral means that you pledge an asset you own, such as your car, to the lender with the agreement that it will be the repayment source in case you cannot repay the loan. Generally, if you're unable to repay your loan and the collateral is insufficient to cover the remaining balance of the loan, you're still responsible for the remaining balance and any fees and interest associated with the loan. An unsecured installment loan is a loan that is not secured by collateral. Underwriting standards are tougher for unsecured loans. Examples include personal loans and private student loans. Secured and unsecured installment loans are generally available only if you have good credit and a stable source of income. We're going to get into more detail regarding secured and unsecured loans after we look at how much installment loans cost. There are four terms you might be familiar with when it comes to understanding the cost of installment loans. These terms are located at the top of the screen. Let's match them with their definition. Dollar amount the loan will cost, including interest, service charges, and loan fees. Answer: finance charges. Loan with an interest rate that might change during any period of the loan. Answer: variable rate loan. Cost of borrowing money on a yearly basis. Answer: APR. Loan with interest rates that stay the same throughout the term of the loan. Answer: fixed rate loan. Stephanie took out a car loan with a 10% interest rate and paid $100 in loan application fees. What lending term reflects the interest plus the application fee? Answer: APR. Michael took out a loan to buy a computer. He must make 24 equal payments over 2 years at 10% interest. Which lending term best describes this type of loan? Answer: fixed rate loan. Kevin took out a loan for a car. He must pay $3,000 in interest, service charges, and loan fees. What lending term best describes these costs? Answer: variable rate loan and finance charges. So, why do borrowers prefer installment loans? When you need to borrow money for a larger purchase, there are certain advantages of borrowing through an installment loan instead of through a credit card or rent-to-own service. You're aware of the monthly payment amount and the time period allowed to pay off the loan. Installment loans, especially when secured by collateral, generally have much lower rates, so it costs you less to borrow money. Repaying an installment loan includes principal and interest according to a preset payment schedule. This reduces the original loan balance during the term of the loan. A loan can be expensive, but it's usually cheaper than some alternatives. What are some questions to ask yourself when looking for a car? Should I get a new or used car? Should I lease or buy? How much can I afford? Should I trade in my old car? There's some factors that you need to consider when deciding between getting a car loan or a car lease. Ownership potential. With car loans, the car belongs to you and the bank that gave you the loan until it's paid off. Then the car becomes yours. With car leases, you're essentially renting the car from the dealership. The lease is like a rental agreement. You make monthly payments to the dealership for a set number of months. The car does not belong to you. When the lease ends, you have to return the car to the dealership. You may decide to purchase the car at the end of the lease. However, the total cost generally ends up being more than it would have been if you had bought the car. Wear and tear. With car loans, no additional costs for wear and tear are included in your loan agreement. With car leases, most leases charge you extra money for any damage found at the end of the lease that goes beyond normal wear and tear. Monthly payments. With car loans, payments are higher, but you only pay them for a set term. Then you own the car. With car leases, payments are lower because you are not purchasing the car. The dealership still owns it. As long as you lease a car, you'll continue to make monthly payments. Mileage limitations. With car loans, there are no mileage restrictions. With car leases, leases restrict the number of miles you can drive the car each year. If you exceed the mileage allowed, you have to pay the dealer for each mile over the limit according to your lease. For example, a dealer may charge you 15 cents for every mile that you drive over 24,000 miles in 2 years. If you drive the car an additional 3,000 miles, you would owe the dealer $450 for those miles. Auto insurance. With car loans, it's usually less expensive than auto insurance for leased cars. Insurance may cost more during the loan than it will after the loan is repaid because the lender may require more coverage. With car leases, it usually costs more if you lease a car than it does if you buy. Most car leases require you to carry higher levels of coverage than purchase agreements do. Some insurance carriers may also consider leasing to be a higher risk than purchasing. And cost. With car loans, purchasing a car is usually more cost effective if you plan to keep the car long term. However, in the short term, the cost will probably be greater than a car lease because your total loan amount and monthly payments are likely to be higher. With car leases, a lease will probably cost less than a car loan in the short term because your total loan amount and monthly payments are likely to be lower. However, if you exceed the mileage on a leased car and/or decide to buy it outright once your lease is expired, it will end up costing you more. Getting a car loan is also referred to as financing a car. A car loan can be used to purchase a new or used car. Your car becomes the collateral for the loan, which means the lender will hold the car title until the loan is paid off. If you do not pay off the loan, the bank can repossess the car and sell it to get the remaining loan amount back. New car loans typically last 3 to 7 years, while used car loans typically last 2 to 5 years. A car loan might be one of the biggest expenses you have. Therefore, if you decide to purchase a car, you should know exactly how much you're paying for the car and exactly how much you need to borrow. When considering a car loan, be sure to shop around for the best deals before you make the commitment. What's one of the main factors you should consider when comparing loans for the best buy? The APR, the annual percentage rate. This will determine how much you will pay in interest over the life of the car loan. So where can you get car loans? You can obtain a car loan from banks, credit unions, finance companies, and car dealerships. Most lenders can pre-approve you for a car loan. This means the financial institution calculates how much money you can borrow to buy a car. Most financial experts would suggest borrowing less than the maximum you are pre-approved to borrow, so you can save more money. This is typically a free service and does not obligate you to accept a loan offer from the institution. Dealers sometimes offer low loan rates and other special promotions. However, to get the lowest advertised rate, you might have to make a large down payment, agree to a short loan term, usually 3 years or less, have an excellent credit history, or pay a participation fee. Participation fee is money that some dealer finance companies might charge to get a low interest rate. For example, although a 0% APR might be advertised, the company might charge you a participation fee of $200 up front. Ads promising high trade-in allowances and free or low-cost options may help you shop, but finding the best deal requires careful comparisons. Many factors determine whether a special offer provides genuine savings. The interest rate, for example, is only part of the car dealer's financing package. Terms like the amount of the down payment also affect the total finance cost. A call or visit to a dealer should help clarify details about low-interest loans. Consider asking these questions. Will you be charged a higher price for the car to qualify for the low-rate financing? Would the price be lower if you paid cash or supplied your own financing from your bank or credit union? Does the financing require a larger than normal down payment, perhaps 25% or 30%? Are there limits on the length of the loan? Are you required to repay the loan in a condensed period of time, say 24 or 36 months? Is there a significant balloon payment, possibly several $1,000s, due at the end of the loan? Other special promotions include high trade-in allowances or free or low-cost options. Some dealers promise to sell the car for a stated amount over the dealer's invoice. Asking questions like these can help you determine whether special promotions offer genuine value. Does the advertised trade-in allowance apply to all cars, regardless of their condition? Are there any deductions for high mileage, dents, or rust? Does the larger trade-in allowance make the cost of a new car higher than it would be without the trade-in? You might be giving back the big trade-in allowance by paying more for the new car. Is the dealer who offers a high trade-in allowance and free or low-cost options giving you a better price on the car than another dealer who does not offer promotions? Does the dealer's invoice reflect the actual amount that the dealer pays the manufacturer? You can consult consumer or automotive publications for information about what the dealer pays. You're not limited to the financing options offered by a particular dealer. Before you commit to a deal, check to see what type of loan you can arrange with your bank or credit unions. When buying a car, you may also be encouraged to buy an auto service contract to help protect against unexpected costly repairs. It may sound like a good idea, but do not buy in until you understand both the terms of the contract and who is responsible for providing the coverage. A service contract is a promise to perform or pay for certain repairs or services. Though a service contract is sometimes called an extended warranty, it is not a warranty. A service contract may be arranged at any time and always costs extra. A warranty comes with the new car and is included in the original price. When shopping for a used car, look for the buyer's guide sticker posted on the car's side window. The sticker is required by the FTC on all used cars sold by dealers. Tells whether a service contract is available. It also indicates whether the vehicle is being sold with a warranty, with implied warranties only, or as is. So warranty. If the manufacturer warranty is still in effect on the used car, you may have to pay a fee to obtain coverage, making it a service contract. However, if the dealer absorbs the cost of the manufacturer's fee, the coverage is considered a warranty. Implied warranties only. There are two common types of implied warranties. Both are unspoken and unwritten, and based on the principle that the seller stands behind the product. Under a warranty of merchantability, the seller promises the product will do what it is supposed to do. If the car does not run, implied warranties law says the dealer must fix it unless it was sold as is. A warranty of fitness for a particular purpose applies when you buy a vehicle on a dealer's advice that is suitable for a certain use, like hauling a trailer. Used cars usually are covered by implied warranties under state law. As is, no warranty. If you buy a car as is, you must pay for all repairs, even if the car breaks down on the way home from the dealership. However, if you buy a dealer service contract within 90 days of buying the used car, your state's implied warranties law may give you additional rights. Some states prohibit as-is sales on most or all used cars. Other states require the use of specific words to disclaim implied warranties. In addition, some states have used car lemon laws under which a consumer can receive a refund or replacement if the vehicle is seriously defective. To find out more about your state's laws, check with the local or state consumer protection agency. Generally speaking, the more money you borrow, the more you pay in interest over the life of the loan. Make as large a down payment as you can so you can borrow less money and pay less interest. After you determine how big a loan you need, pick a repayment period that makes sense for you. For example, a $15,000 loan at 4% interest for 36 months equals a monthly payment of $443. Stretch the same loan out to 48 months and the monthly payment drops to $339. While it's tempting to go with a longer loan to reduce the payment, you must consider the total cost of the loan. By extending the term of the loan, even if the payments are lower, you'll be paying additional interest. As a guideline, you should be cautious about taking on an auto loan term of 5 years or more. If you must take on a 5 to 7 year loan, it's quite possible you are buying more car than you can afford. Think about the amount of time you plan to own the car and how long you anticipate the car will perform well. You may owe more on the loan than the trade-in value, or you may still be making payments on it while paying for extensive repair and maintenance costs. Once you own your car, you also need to be careful of title loans. Generally speaking, the more money you borrow, the more you pay in interest over the life of the loan. Make as large a down payment as you can so you can borrow less money and pay less interest. After you determine how big a loan you need, pick a repayment period that makes sense for you. For example, a $15,000 loan at 4% interest for 36 months equals a monthly payment of $443. Stretch the same loan out to 48 months and the monthly payment drops to $339. While it's tempting to go with a longer loan to reduce the payment, you must consider the total cost of the loan. By extending the term of the loan, even if the payments are lower, you'll be paying additional interest. As a guideline, you should be cautious about taking on an auto loan term of 5 years or more. If you must take on a 5 to 7 year loan, it's quite possible you are buying more car than you can afford. Think about the amount of time you plan to own the car and how long you anticipate the car will perform well. You may owe more on the loan than the trade-in value, or you may still be making payments on it while paying for extensive repair and maintenance costs. Once you own your car, you also need to be careful of title loans. Title loans are short-term, usually 1 month, loans that allow you to use a car as collateral to borrow money. They may sound like a good way to get quick cash, but they can be very costly. Here's an example of how costly a title loan can be. Michael had $500 in unexpected medical expenses and needed a loan. He saw a television commercial that declared, "If you have a car, you can get a loan." Michael had a car worth about $2,500, so he decided to apply for the loan. The finance company Michael saw in the commercial loaned him $500 at 20% interest per month. Note that the finance company did not advertise the APR. The finance company took his car title as collateral, and Michael kept the car. With a 20% monthly interest rate on the $500 loan, Michael owed $600 at the end of the month. The $500 loan plus $100 in interest. Michael could not repay the $600 at the end of the month. The lender could have repossessed the car. However, the lender gave Michael the option of just paying the $100 interest and gave him until the next month to pay the loan. At the end of the next month, Michael still owed $600, the $500 loan plus another $100 in interest. Michael went back in every month for the next 11 months to pay $100 to extend the loan another month. Finally, Michael received a bonus from work and was able to pay off the $600. By the end of 1 year, Michael had paid $1,200 in interest for his $500 loan. This equates to a loan with a 240% APR. It's an expensive way to borrow money. We'll move on now and discuss unsecured installment loans. Unsecured installment loans, sometimes called personal or signature loans, can be used for a variety of personal expenses, such as bill consolidation, education expenses, or medical expenses. There's no collateral requirement for an unsecured loan. The terms of the loan might range from 1 to 5 years. Since credit cards have become popular, the use of unsecured consumer installment loans has declined. However, some financial institutions still offer unsecured installment loans. Benefits of unsecured installment loans generally include fast approval times, lower interest rates than credit cards. Drawbacks of unsecured installment loans: interest rates are generally higher than unsecured loans, and lenders might have stricter credit requirements since there is no collateral to collect if the borrower does not pay. When considering an unsecured installment loan, make sure the new APR is lower than your current APR if you plan to use an unsecured installment loan to consolidate your other loans. Beware of companies and websites that charge high rates and application fees. Look for hidden charges. Ask for references before signing an agreement. Beware of debt consolidation traps when you consider getting a loan to pay off what you owe on several credit cards. Shop around so that you have the information you need to decide on the debt consolidation loan that best meets your needs and budget. Research different lenders and collect quotes before deciding. Choosing the wrong debt consolidation loan can make matters worse and put you further into debt. Consider credit counseling if you become overwhelmed and are unable to make the payments or have trouble paying your bills. Reputable credit counseling agencies can help you budget and negotiate with your lenders to make loan payments more manageable. Refund anticipation loans are short-term loans secured by your income tax refund. Although the business preparing your income tax return will give you the money, you're actually receiving a loan from a bank or finance company. Because you don't have to pay any fees associated with obtaining a refund anticipation loan at the time you receive the money, you may not realize how much this loan is really costing you. For example, your tax refund is $1,500. The income tax return preparer's fees and the fees for the loan total $300. You will receive a check for only $1,200. It's important to remember that the paperwork you sign to receive a refund anticipation loan will legally obligate you to repay a $1,500 loan. This is true even if your refund is less than the amount the preparer initially calculated the refund to be. Keep in mind, when you electronically e-file your tax return and request direct deposit, your refund is often deposited into your bank within 2 weeks. Sometimes refund anticipation loans take just as long, yet they cost you substantially more money. When needing money fast, many people turn to alternative financial service providers, including pawn shops, car title lenders for a loan secured by the borrower's car, and payday lenders for unsecured loans that borrowers promise to repay out of their next paycheck or regular income payment. While many non-bank lenders advertise quick and easy cash, their services tend to come at a steep price. The best way to avoid a cash crunch and having to borrow at a high cost is to put money into an emergency savings account that you can use to pay for unforeseen expenses. Experts say this fund should equal about 3 to 6 months of living expenses to get you through a difficult period without having to take out a loan or borrow from retirement savings. You can perhaps even link your savings account to your checking account to protect yourself if you were to ever accidentally overdraw your checking account. If saving money seems impossible to you, consider making small, simple changes in your habits or banking practices. Possibilities include having your paycheck directly deposited with a portion automatically placed into an emergency account. What are some ways you can save and build an emergency fund? So, if you need to borrow money, it pays to comparison shop. When comparison shopping for loans, look at both total dollar costs and the APR. If you find that you must borrow money, beware of alternative financial service providers that may promise quick cash. As we just saw, these services, such as payday loans or car title loans, come at a steep price and can trap you in debt. Many banks offer reasonably priced, small loans that enable you to borrow money and repay the money, plus interest, later. Be cautious of using fee-based overdraft programs to deliberately overdraw your account if you need cash quickly. The costs can quickly add up depending on the number of transactions covered. Another resource you could try would be the Boise State Dean of Students Office and the Student Emergency Fund. Offered through the Dean of Students Office, the Student Emergency Fund provides financial assistance to Boise State University students who are in danger from withdrawing due to unanticipated temporary financial hardships resulting from emergency or crisis situations, such as accidents, illness, deaths of family members. Funds will be awarded as grants to help alleviate short-term financial needs. If you think you may qualify, please submit the Student Emergency Fund application along with supporting documentation. Fund stipulations are: grants cannot exceed $400. Grants may be awarded once during a student's academic career. Grants do not have to be repaid on your hardships. Fund qualification eligible expenses include medical, dental, housing, rent, utilities, books and school supplies, food and groceries, personal, automobile and travel, and childcare. Ineligible expenses include tuition, student fees, and legal fines and expenses. So what qualifies as an emergency or crisis situation? Situations include but are not limited to accidents, medical or dental emergencies, natural disasters, travel emergencies, and need for temporary housing due to unanticipated events. To view additional requirements and to review the application process, please visit the link on this slide. If you find that you do need to apply for a loan or credit, please know that there are many federal consumer protection laws. In fact, there are too many to cover in this module. However, you should know that the financial institutions must follow certain laws and regulations to protect your rights as a customer. Laws that protect you when you are applying for a loan or credit include the Equal Credit Opportunity Act, Truth in Lending Act, Fair Credit Reporting Act, Fair Debt Collection Practices Act, and the Fair Credit Billing Act. There may also be state laws that give you additional protections. Consider your state's Department of Consumer Protection or Attorney General for more information about your state's laws. Resolving complaints. If you have written a letter to the bank that does not produce the results you desire, you can write to the bank's regulator for assistance. Sometimes that means writing to the FDIC. State the problem briefly. Explain what occurred and how you would like to see the matter resolved. Include your full name, address, and daytime and evening telephone numbers with area codes. Provide the complete name and address of the financial institution, along with the names of employees who have assisted you with your problem. Include pertinent account information, including account numbers and the type of product you have, such as checking account, savings account, home equity loan, or home loan. Include important dates, the date the transaction took place, the date you contacted the financial institution about your problem. Send copies of documents that may help explain your problem, and keep the original documents. Sign and date your letter. There are a few more laws and regulations that you need to know about before we continue. So, in closing, some additional lending laws that give you additional protection include the Service Member Civil Relief Act, Real Estate Settlement Procedures Act, Fair Housing Act, and the Consumer Leasing Act.